What's up, Outliers? Welcome back to the Outlier podcast. I have David Hunter back. I think this is like episode 6 or so. I don't even know anymore. We've connected pretty much every quarter, like pretty consistently for a couple years now. And I would love first to just start with a quick recap of 24, because when we connected in the beginning of 2024, you had an expectation of this really strong rally, the melt up, and then leading eventually into the global bust. And originally, we were thinking that that might be happening towards the tail end of last year. Obviously, circumstances continue to change. That's actually a follow-up question I have for you for a little bit. But I would love to just get an overview from you on 2024. What were the key themes that stuck out to you?
Yeah, well, certainly, we had had a pretty good correction going into the fall of 23, came out of that in October, early November 23. Um, and it took until I think February, if I remember right, before we started taking off. Maybe that was just the metals, but I had raised my target to 7,000, I think, in January of 24. Um, and we had a run, and we had a correction, another run, um, and then August hit, and we had the big, probably the biggest story of 24 was the Japanese yen carry trade uh, unwind.
Mm-hmm.
And it didn't take very long, but it was pretty sharp and scared a lot of people, and had a lot of people turn bearish there. And yet it bottomed in early August. It was almost a 1 day sell off. There was some weakness leading up to it, but the biggest sell off was a 1 or 2 day deal.
Mm-hmm.
And then we basically had a pretty good run into the election, and the week after the election, and then another kind of holiday run after Thanksgiving or into Thanksgiving and beyond. And then we thought we were going to have a year-end rally, and really from mid-December and for the Russell early December, we had topped and corrected right into year-end. So um, it surprised people, I think, a little, because everybody assumed we'd have a year-end rally. But that's the market, when everybody assumes something, you're going to probably get the opposite. And we're starting off this year kind of choppy. So
Yeah.
it's what has been amazing is it has rebuilt the wall of worry. The it doesn't take a lot to have people. They got on board because of what the market did in the fall when they saw the S&P go above 6,000. All of a sudden, you had everybody raising their numbers for 2025. Their year-end 25 Wall Street strategists for year-end 25 estimates all jumped up, 6,500, 6,600. A couple of them were at 7,000 or 7,100. And this was from a crowd that, a group of people who had fought the rally all the way up from 3,500. They just didn't think it had legs, and it kept moving. They were skeptical the whole way until, really the last, just leading into the election and beyond. Um, and then just as we get that and they climb on board the bull bandwagon, we get this correction. And I think, for the S&P, it was a less than 5% correction. For the NASDAQ, 6% or 6.5%. And for the Russell, it was over 10. But it's amazing to see that once you lose that momentum, and I had said this ahead of time, yeah, they're bullish, but they're bullish without any conviction. They're bullish because they're going with the momentum of the tape. You lose that momentum, and they're right back on the bearish side, or at least skeptical side. And that's what you've seen here very recently. And
So,
if you look at individual sentiment, because I just saw this number, the bulls are down to like 20, I think 24%. The bears are up to 40%. And that had been the opposite, just a few weeks ago. So it's amazing how quickly, a little bit of a pullback can cause sentiment to change.
absolutely. And it's one of the things I wanted to follow up there with is your original expectation of a melt up, meaning a really sharp parabolic move up. How does this change in sentiment feed into that? Because it does seem like things have stalled quite a lot. And exactly to your point, I actually found it generally interesting where essentially from December, it just seemed like the market was kind of waiting for the shoe to drop, which surprised me a little bit because if we're expecting this really big rally, right, it seems like it would have to be supported by a ton of capital of some sort coming in. So, two questions there. The first one is, what do you think about the current market condition and how does that feed into the melt up concept?
Yeah, well, first of all, just to kind of clarify, melt up and parabolic melt up are two different things.
Okay,
So
sorry.
the melt up, we've really had a melt up. You could argue, depending on how wide you want to make how wide a perspective you want to have. If you broaden the market out to 20-year charts, you'd see the market's pretty vertical from 2022, from the lows in October 2022 to now. Some people think that was, that whole thing is a melt up, but we did have a pretty long correction in the summer into the fall of 23, and then bottomed in October 23. So I really think the melt up is from that October 23 until now, is we're in the melt up. The parabolic part of the melt up is that last stage into the top. And I have thought it was starting. I had thought it had started after the election. I said at least possibly, that 5% run in the week of the election, look, if it had sustained itself, was the beginning of what I think we're going to see, which is, a very fast, steep run to the top. But it stalled out, and we've kind of gone, sideways since. So, and sideways to down. So that wasn't the beginning of the parabolic. I think the parabolic's just ahead of us, and I think you could cover 30% in the S&P in a matter of 2 or 3 months. Maybe it'll take longer, maybe it'll take 4 or 5, but that's a lot of return in a hurry.
Huge. And
so that, just to clarify those two, then
got it.
Then if you could refresh my memory on your questions.
I'm curious how the current market behavior feeds into that broader theory.
Yeah, I mean, I view it as we're in that process.
Okay.
We're so spoiled because we haven't had big pullbacks. We're getting these 2, 3, 4, 5% pullbacks, and those seem now to be big pullbacks. They're not. Historically, we just haven't had this kind of a straight up market. So people are more conditioned to have 7 or 8 or 10% corrections. Now, if we get a 4 or 5% correction, people are saying, "What's wrong with the market?" I go, "This is just the market refreshes itself. It's a stair-step process, and each time it pulls back, it causes bearish sentiment to increase. Obviously, investors act on that sentiment a lot of the time, so that means they're getting more defensive. They're raising more cash. It's rebuilding the skepticism that you need to keep going higher. What you have to worry about is when sentiment gets so bullish that everybody's in agreement that this thing's going so much higher. That means they've acted on that, and you're already at the top. So that's coming, but we're not there at all now."
Leads to an interesting follow-on based on your comment around perception around pullbacks and like severity. What I find really interesting is on some of these, exactly to your point, lighter pullbacks, we're actually seeing the VIX spike, not crazily, but pretty meaningfully. And what does that mean to you then? Is it like just broader institutional support of that theory where we've become so complacent where a 4%, 5% pullback is seen as VIX needs to go to 25 now because of this small pullback, which we typically wouldn't necessarily see to that degree?
Yeah, I can't remember when that last spike was where the VIX went up above 30, I think, or got to 30.
Yeah, it looks like that happened on the 18th of December and the VIX hit a high of 28.32. And then the
Yeah,
last
so
Yeah, and then the last time it was above 30 was during that August pullback where everything kind of rolled over a little bit.
yeah, the August one for sure was, people panicked, and that was, people were so sure that we were heading straight down. You had a lot of estimates of, big drops.
VIX
They thought that was just the start of something much bigger. So
VIX
that
hit a
one was
high of, sorry, I was just going to throw out there. VIX hit a high of
60.
65
Yeah,
intraday there. Yeah.
yeah. That's the sign of real panic. The one in December, I can't even. It's funny. I can't even remember what it was that triggered the pop. There had to be some news event, but
Well, yeah,
that coincided with, or came soon after, the top of the market, because the market top, or the market top right around there, because it was before Christmas. Um, and I can't remember what the news event was. Do you remember? I can't. It's funny.
yeah,
But
that's
there
kind
had
of
to
the,
be something there.
yeah, it's kind of the beautiful.
It may have been the pop in interest rates, because interest rates had gone up from 360 up to three to 420 or 430, and then started to come back down, maybe even up to 440, started to come back down. And then I think we might have gotten a bad CPI report. Or yeah, that's what I think it was. It was inflation, and that spooked everybody. And yields went from they had come back down from 340 to, I think, 320. Next thing you know, they were at 360 on their way to 380 on the 10-year. So I think that was, if I remember right, that was what triggered it. Was the fear that
the 18th was also I'm pretty sure there was a Fed meeting around there, a Fed announcement.
Yeah,
and then
it was right in there. Yeah, because the CPI may have come out just before that, and then
yeah,
Powell. The amazing thing was Powell's press conference.
Right. Because I remember that being so noteworthy. I was just like, the market is crashing on him essentially saying the same thing.
Yeah, it was. He basically telling you we cut rates in September, we cut again in November and December, and we may have to sit for a little while and wait for the data to tell us what to do next. I thought we knew that going in. Why is everybody panicking? But that was the story. So again, there's a case where right around there, going into that, you had was when people were giving you their year-end 2025 numbers. The strategists on the street are telling you about the next year and starting to give you the year-end numbers. And so they had raised all their numbers right before that, and which I guess is a sign that they were too comfortable. Had gotten pretty bullish. Like I said, without conviction, but they were bullish because the tape was up, and they just didn't have. There was no resilience in the market for bad news, and they interpreted whatever he said as a change, and it wasn't really. But and along with that was the narrative we were seeing in some of the data that the economy was better than expected, was starting to show more resilience, not rolling over, and that inflation was ticking up. So even though none of that concerned me, it sure concerned the street.
Leads to a follow-on. This is one that continues to confound me. I just wrapped up my 18th year of trading, which I mentioned to you because it's funnier than anything. You've been in markets more than double that. But I find it so interesting because my general expectation is that institutions are pretty smart. They probably have people that are close to Powell in some capacity. They're probably hearing things being talked about here and there. Not to go so far as insider information necessarily, but also probably not off the table. It's just so surprising to me to see when the Fed comes out and they essentially reiterate similar guidance, to see the market shuck that hard and VIX fly that hard. In my mind, I'm like, well, I struggle to believe that institutions were caught that far off sides. But so what causes that from an underlying market perspective?
You can probably understand this even better than I can, being a trader. It's all about positioning.
In short-term sentiment.
And short-term positioning too. I mean, they're going in with, and traders are by definition more fickle, right? They can have one opinion one day and a totally different opinion the next day, whereas my opinions haven't changed much in 2 years, So, or maybe even 5 years. But Um, so it's a lot of it is they're parsing every word, they're looking at everything for any potential change, and whether any of them want to admit it or not, they're driven by the tape. So if he had said the same thing and the tape had gone the other way, that wouldn't have been anything they would look at.
Right.
It's the combination of their positioning and what then soon begins to happen at the margin. If it starts, then they say, "Oh, his rhetoric seemingly is indicating we might be done with cuts for a while. I got to get out." And then once you drove yield so fast, it spooked the market.
I see. Interesting. Now, another thing I noticed with like near-term positioning to follow along on that and continue putting you out of your comfort zone talking about short-term stuff. I find it so interesting that it seems like the market is digesting any sort of inflation level data, and it seems like it's like hypersensitive to the downside, but it's not really showing that to the upside, right? Like when we got the slightly lighter CPI yesterday, the market went up, but it's not like flying up. Whereas it seems like if that came in a little hot, the probability in my mind is that the market was probably going to show a pretty big hand to the downside. So what do you think about like that general function right now as it sits?
Yeah, that's good insight because I do think it's indicative of the nervousness that's still built into this market. It confirms for me it's certainly not, it's not where I spend most of my, I mean, sentiment's important to me, but I don't spend a lot of time trying to analyze it day to day. But it does kind of confirm for me that people are still one foot out, one leg out the door. They are they are more comforted by the market having shown resilience, and they may talk a good game about having higher numbers, higher targets, but they're scared as hell. They're wrong,
Right.
and so the minute the and for maybe I'm not, I don't want to overstate this, but I was talking about a global bust, 5 or 6 years ago, saying not that it would happen right then, although it
Sure.
could have happened a lot sooner than we are now. But I always said, we'll have a melt up and then a global bust, and I defined that bust long ago. And now you see a lot more people using the term bust that never did before. Some misusing it, but some using it like I'm intending that it's bigger than, much bigger than a normal recession. I think I planted the seed in a lot of people's heads, and then others that may be saying the same thing now or doing it too, that there's this fear in the market. Unlike, going into lots of our recessions, they don't, we don't go into every recession saying, "Oh my God, the market's gonna, the economy's gonna blow up bigger than it's ever blown up." This is unusual. We had it in 2008-9, so that's part of it is we have that fresh in our mind. But it's also because of the setup, because of the massive leverage. My forecast has been out there for a long time that this isn't going to be an ordinary downturn. That when it goes, we can have the biggest financial crisis in history. We can have something, is one way I put it. We can have something bigger in 2008-9, which is another way to put it. And then I accompany that by saying we could see an 80% bear market, biggest since 1929. Those things are out there. And again, I'm not trying to take credit for everything and saying I'm the only one thinking that way, but I was the first in terms of thinking in those kind of exaggerated terms, who saw this cycle in those kind of terms. Um, I do think that's in a lot more both institutional and retail minds than in previous cycles. That it's not only are we rolling over, are we going into a bear market? It's they're scared to death that this could be the big one, you know. And there may be other reasons they're scared of that too. It's not just my, the view I put forth, but I do think that's in the, whether it's me or was other things. I think in the back of an awful lot of institutional investor minds is when this goes, it's gonna come at us very fast and it's going to be very steep. So they don't want to be late. There's this real fear of being late, more so than in most cycles.
I see. And given that fear and then the implication then for kind of near term positioning, How does that then lead into the melt up? Because typically when I think of the actual melt up portion of this, where things start to get more parabolic in nature at some point, I continue to go back to, like, I'm curious what the catalyst then would be. And it looks like the next Fed rate cut isn't really priced in until the summer. It's like June, and it's only like just over 50%. So it's real light at this point. So then I'm thinking that's coming up, but not until summer. So then does that impact the timeline that you would expect for this melt up, or is there another catalyst that could contribute here?
Could be another catalyst, but I don't even think it's another catalyst. I think that's the narrative today that can change to the narrative that causes this thing to go. In other words, if people are now convinced that there's no cuts coming for 6 months, and if we get a weak, we start getting manufacturing certainly weak. We got a very weak, the most recent New York reading on
The manufacturing index?
the manufacturing
Yeah.
was very weak, right? If we start seeing weak data, ISM has still been negative. Most of the time it was a little stronger recently, but if we start getting negative data again, people are right back on the side of a narrative that says weak economy. And if inflation, I'm hearing it again, I don't know this, but I saw something today where PCE, and people can take CPI and PPI. I don't do it, but some of the economists claim they can pretty much give you what PCE will be. And there's numbers out there of something under 2%. Maybe well under 2%. I've seen 1.9. I've seen even lower. Um, if people get convinced that inflation is not ticking up, but actually still trending down, and if the economy, data points start showing, data releases start showing the economy is slowing more, I think you'll be right back in the narrative of, we could have 3 or 4 cuts this year. They'll start with,
I see.
it'll start with, yeah, those 2 cuts look pretty, I'm confident in 2 cuts again, instead of what, there's starting to be talk about no cuts, or even people, even though they don't think it's a high probability, talking about the possibility of the Fed raising again. I think that's not going to happen. I think we're likely to get 4 cuts this year. I don't even,
Or
number of cuts to me is, a game. I don't worry about that, but it is part of measuring a narrative, which, where's the narrative, the 2 cuts is the 4, whatever. But personally, I think the bigger story is going to be that this economy is going to slow faster than people expect. Maybe be in recession much sooner than people expect, and then from there, see even worsening from that, and that inflation is actually, we may be finally getting to the point where, because shelter was a net help this time around in terms of inflation lower. I think it came in below expectations. We may be finally at that point where shelter starts going. He starts, recognizing the weakness in shelter, because it was such a laggard. It was, for a long time, it was kind of propping up numbers. So I think we may be at that point where you get the opposite, where shelter is actually contributing to the weakness in CPI and in inflation. And I think you're gonna have to, in other words, it's almost like you're gonna have the wind at your back for the markets if numbers are starting to come in below expectation.
really interesting. So it's almost like the bad news becomes good news in a way.
Absolutely.
Yeah.
I have said for a long time, I think the much more likely way we get to a top is weakness in the economy, not strength. I
Very
think
contrarian.
I think the likelihood is that the narrative that we have as we move to the top is going to be weak, softer economy. I don't mean it's bust, but softer economy, maybe even recession nearby, lower inflation, and Fed ease. Fed is back on the ease story, and in fact, maybe the Fed has to catch up now. Because they still are behind the curve in terms of tightening, and people don't. I don't even talk about it a lot because it hasn't happened yet. But we keep talking about Fed ease in terms of rates, and this is as long as I've followed the Fed, which is 50 years. Um, that has been part of how Wall Street sees things. True ease is the money supply, is the Fed's balance sheet. The Fed's been tightening. Even now, they've been shrinking the balance sheet. So, true ease is when they're printing money, when they're expanding their balance sheet again. We're not seeing that at all. So the Fed is still tight and tightening. And yes, rates have come down, but that's not ease. Although, in Wall Street language, it's ease, but it's really the rates are following the market down.
What do you make of the relationship still between small cap and large cap? I thought it was noteworthy seeing the Russell contract as heavily as it did in December. And as compared to things like large cap, which has started at least a little bit, maybe it's just a relief rally because it still looks like it's in a downtrend again from a trader's perspective. But small cap's kind of just been hovering sideways here. So I thought the weakness there was just generally noteworthy. Do you make anything of that?
I think it is noteworthy. It's more of the same in terms of what I said before about kind of how positioning leads to what you get, so it leads to a correction. I think so many people finally jumped on, so many people fought the Russell for a long time and said the Russell's, um, dog poop.
Yeah.
It looks like it's never going to go again. And I had those questions on Twitter forever. Um, and then it all of a sudden lifted its head and had that big run. It outperformed in the summer, and then it went to sleep, underperformed all the way into the election, I think. And then it had that run after the election where it double topped. It went to it back to its all time highs, and then kind of topped out in early December, and like I say, it corrected 10 or 11%, much more than the other indexes. I think that was because that run, first in the summer, and then the second one into early December, had people jumping on the bandwagon saying, "Yeah,
Mm.
small caps are coming alive. Yeah, small cap." And you heard on, if you listen to CNBC or anywhere, you heard portfolio managers coming out talking up small caps, saying, "Yeah, I think the markets," which I've been saying for a while, is the market was going to broaden out. But you had more and more people saying, "Yeah, with Trump coming in, it's going to be, better for the economy and better for the domestics, and that really favors small cap, and all that." So you had kind of bullishness rise up for the increase for the Russell, and it just meant it's time to put those people in their place and get that wall of worry back up, because everybody's jumped on that bullish small cap bandwagon, and that's what I think it took, was a bigger correction. And then, I mean, I saw in the last couple of weeks, the Russell's awful. How can you tell me the Russell's going to 3,300? There's no way. That index should be, taken out and buried. They really were getting upset with it because it obviously had disappointed them. So
Yeah.
I see this as nothing other than that. It's more the game with sentiment and positioning. And now it's starting to come out of that hole. 3 or 4 days ago, it came right down to the 200-day moving average on Monday, I think,
Yep.
and turned. And I think we've seen the bottom. And I think 3,300 is likely. So it got below 2,200, got down to 2,160, I think, 2,160, 70.
Yeah.
Yeah, 2,160, 70. So 3,300, 2,200 to 3,300 is 50%. So from there, it was basically a little more than 50%. That's what I think in this parabolic, that's what you're going to get. If you can get 50%, if the parabolic truly is first half of this year, whether it's 3 months, 4 months, 5 months, I don't know. But if you get that and you get a 50% move in the Russell in that time frame, that's that's pretty historic, I think.
Yeah. Well, especially if I think, again, going back to your broader comments around what would drive this, because it seems like we would need to see economic data starting to show weakness. Is that the main thing that you would see for the Russell specifically, or does it follow the broader narrative that you're talking about before?
Yeah, it's basically for the whole market.
Yeah, okay.
I think you're going to have lower interest rates, weaker dollar, um, and of course, the Russell is also more financial, so I think they will benefit from all of
I see.
that. And so will domestic, and it's I talk less about it because it's not really the macro story, but having Trump come in as of next Monday and pushing a pro-capitalist, pro-U.S. policy is very much favors the Russell.
I see. Well, literally beautiful segue too. So we saw an initial rally, obviously, when Trump won the election itself. Do you think that there's going to be a sympathetic follow through when he actually takes office, or do you think a lot of that stuff's already been priced in based on the stuff he's been talking about, his policy expectations and stuff like that?
I don't think it's priced in because I think everybody kind of got distracted by the yield curve.
I see.
With rates moving up and the dollar moving up, people kind of got caught up in the bearish side of the story. So I think you had that initial spurt right after the election when he won, and then really and a little bit more into December, but then after that it's been all negative. So not because of him so much, but more focus on well, there is a narrative that has been a negative narrative of for Trump, and that regarding Trump, and that was the idea that tariffs are inflationary, the idea that his policies, CBO and various Wall Street economists are all pushing this idea that he relative happened before the election, and I argued against it back then, but that his policies were more inflationary and would cause higher deficits than Kamala's would, and and certainly more than Biden's. And I disagree with all of that. The problem is that most of those that score these policies hate supply side economics, don't believe in supply side economics, do all of this stuff in a static model, meaning they don't give you any credit for lower tax rates leading to higher growth and higher growth leading to higher tax revenues. It's been proven. It was proven in the Reagan tax cuts. It was proven in the first Trump tax cuts. When you do large tax cuts across the board like they did, it does boost the economy, all things being equal. The problem is, at the end of the Trump administration, all things weren't equal. We had a pandemic. And so, we had the early stages of having to prime pump and push all kinds of new fiscal money out the door. So it kind of short circuited what would have been growing revenues and lower spending, or not bigger spending. Um, but the problem is in deficits is spending. Our problem is not tax cuts. If you cut taxes, you're going to get higher revenues. And so, but partially because they don't believe in them, partially because they don't, partially because I think a lot of these people scoring have TDS. Um, I think the combination of those two things, you end up with assumptions that are, I think, very faulty. And so my belief is his policies will not lead to higher inflation, will not lead to bigger deficits. That all being said, my forecast, which is that we are going to have much higher inflation after the bust because of the massive money that gets put into the system, not just here but around the globe. But that's not because of Trump policies. So the initial response, I think, once he gets elected, is that you are going to get another big boost to the market.
Do you think the conversations he's having around increasing tariffs with big trade partners like Canada, Mexico, also him trying to increase just domestic production? Because you know all this way better than I do, but my expectation of some of those policies, depending on how they're implemented, in my mind, I was expecting short-term pain that might lead to longer-term relief. But it sounds like you're thinking, when you're talking about not being super inflationary, what time frame are you using for that? And then do you see any short-term issues based on some of those policies that would then alleviate longer term, or do you think that there would be essentially none right out of the gate?
Yeah, so I have to talk about reality versus what I think will happen in the real world
Okay.
versus what I think the narrative is going to be. So in other words, under my bust forecast, it's not a given, it's my forecast, right? Where I say we're going to have the biggest downturn in the post World War II era, we're going to have the biggest financial crisis maybe ever globally, um, and leading to maybe 20 trillion in Fed expansion, and likewise proportionally around the world. That jump starts an inflation cycle like no other. We'll see 25. In my opinion, I've said this to you before. We'll see 25% inflation by early next decade if I'm right about that. So I'm not saying Trump isn't going to be living, that we're not going to be seeing inflation the balance of this decade. I think we're going to see deflation first, and the response to that deflation is going to cause inflation. But that's a macro story that's not anything to do with Trump's policies. So, and we don't know that that's going to happen yet. And if we're going into a period where we're going to have more of a euphoric stage where everybody's excited that Trump's policies are more pro-capitalist, more pro-growth, inflation's coming down, the narrative of the next 6 months is likely to be very bullish. So they're not going to be focused on, because it won't even be evident at that time. They're not going to be focused on, a global bust and a response to the bust is going to be inflationary. If things start popping up that say global bust, the focus will be deflation, right? Not inflation. I step ahead and talk about what happens in terms of response and things. That's not how the street works. The street's going to be focused first after the inauguration on Trump's policies and those being positive for growth and bullish for the stock market. And then if they start seeing signs of bust, they're really focused on deflation, which means even lower rates, which even means even more Fed ease, right? So there's a period here for the next 3 to 6 months, and I don't know whether it's 3, 4, 5, 6, where I think most of the narrative is going to be towards lower rates, lower dollar, lower growth, lower inflation, much higher stocks. Somewhere in there, whether it be April, May, June, I think it will be in a euphoric period where it will behoove people to start looking past that euphoria to the fact that there are storm clouds on the horizon that could come pretty fast, meaning Europe's starting to look like dog poop. Canada's in trouble economically. Asia's, China's struggling, et cetera. Those kind of things could be out there by mid-year, and maybe our economy's, moved into recession. And as I say, the reason I'm calling for a bust is because we've got massive leverage on that system, much bigger than 2008-9. That's really the story of why it turns a recession, an ordinary recession, into something worse. But the first step is to get into that recession.
I see. Now, speaking of different policy changes and expectations, what are your thoughts around energy and metals, what they might look like, kind of decoupled from the melt up and bust itself, but just kind of talking about the performance expectations of energy and metals given the policies expectations, and then obviously we can mold them together with how they interact with the melt up and bust.
So let's start with oil. Oil's had this run from the mid 60s to the high 70s in the last, I don't know what, couple months. I think that run should be over or very close to over. It ticked down today, but who knows? I'm still of the belief that we're heading for 60.
Okay.
It's not unusual to have a run. We came down from 130 back in 22, came all the way down to the 60s, and then back up into the 80s, mid 80s, I think, and then back down to the mid 60s again, and now up to the high 70s. I think it's part of that stair step. It plays out over many months, but it's what I think's going on. I think the next step is another run down to even lows than the mid 60s. So probably 60 or high 50s, and that coincides with the economy getting softer as we move towards mid year. Again, doesn't mean it's soft. The next set of data points, I'm not trying to tell you it happens in the next 2 weeks, or 3 weeks or 4 weeks, but over the course of this first half of this year, I think we're going to see a softer economy, lower demand, and of course, worldwide, Germany's in negative GDP now, China's in deflation now, so you're going to see worldwide demand for oil, I think, continue to slip. At the same time, Trump's coming in and talking about, drill baby drill right from day one. So how fast that all plays out, I think it's in the narrative right away that oil supply is going up, and my belief is oil demand is going to continue to soften. That leads to weaker prices. So that's what I think the next several months is. And then I've said in the bust, if I'm right that the bust happens later this year, in the bust, I expect oil to go to $30. So I think we've pretty much seen the high water mark or close to the high water mark in oil. Watch it next week go to 85. But I think we're in the last stages of any strength in oil, and I think it just begins a downtrend from there.
Before we go into metals, for the oil component, just out of curiosity, do you think softening demand would then lead to production slowing, or do you think that we would start storing? I'm just wondering how those two different things come together.
Well, yeah, my guess is, and I don't know this obviously, but my guess is Trump's of a mind to get oil up, right? He's not trying to predict the oil price in the next 6 months. He's just looking and saying, if I were president the last 4 years, we would have had even more supply, and we got to get oil up. And he's focused really on us being totally independent of supply coming in from our adversaries or anybody. That we are self sufficient in oil. So he's looking at it as lower oil prices, lower gasoline prices helps the economy, helps the consumer. Higher oil production helps, Pennsylvania, helps oil companies, et cetera. So I think he's not going to be all focused on what's the price of oil going to be in the next 6 months. So I think the likelihood is, at least for the next several months, he's going to be encouraging more drilling. Now, what the oil companies do in terms of their focus, they may be a little more focused on, we want to hold back some of that supply because, the market's weakening. So it's not, his policy may not go one for one right into a big increase in supply because it's got to be done by the companies themselves. But I think in general, the narrative of the next 6 months is going to be towards higher supply or towards, more drilling.
I see. Got it. Okay, cool. Yeah, thank you for the clarification there. And I know we're coming up on time here, but there's just a couple other things I wanted to run by you. Definitely.
Well, you did ask about the metals. If you want,
I was going to ask if we could cover metals. Yeah.
Yeah, it's kind of key. I think the metals look great here.
Okay.
Silver. First of all, gold. I mean, gold is coming out of a consolidation over the last several months, where particularly if you look at it on a monthly, kind of came into a wedge technically, and it's breaking out of that wedge as we speak. So we're not far from highs. I think we'll push through the old high last year, and my target is 3,400, and I think I'm very comfortable with 3,400. If it exceeds 3,400, it won't surprise me. And that's, again, first half of this year probably. Could spill over from there, but I think most of it's this first half. Silver has been the laggard of the two, particularly the miners of silver. Yeah. But I think silver is also showing it's coming out of consolidation. it got up to 35.5, I think, in its run early, last year or whatever, towards the end of last year, and it's corrected down to got just below 30, and is now trying to turn around and get going here. I think we'll be back above 35 pretty quickly. I don't know whether it happens in the next month or it takes 2 months, but my guess is it's the next month and on its way to the mid 40s. And then from the mid 40s, I have a target of 75. So again, it's coming from farther back, so it might take longer. In terms of, it may take more than 6 months, but it can also get going fast and could be, most of that move could happen in the next 6 months. So that's a hell of a move if we go from 30 here or 30, 31 here to 75, and that's kind of what I expect. By the way, the gold silver ratio, which had rolled over last year because silver did pretty well for a while, and gold had consolidated some of their run. Well, silver just goes faster when it goes. It's percentage wise moves faster. So in the bull run, we had brought the gold silver ratio down from 80 or 85, 90. I don't remember where it topped out there. And then it turned around here in this most recent correction because silver corrected more and went back towards the high of that ratio. If you divide 3,400 by 75, I think it takes you down towards 40. Let's see. Yeah, I think it takes you down towards 40, 45, something like that on the ratio from up over 80 or 85. So what that means is as that ratio drops, that favors silver. It means silver is outperforming gold. And that's exactly what you get in bull markets in the metals. So I expect that. The miners themselves, which have lagged by a lot, I think it's just a matter of people need to gain confidence that this isn't going to be another one of those failed rallies in the metals. They go and then they stop, particularly silver. They look like they're lifting out of a consolidation and then they stop and correct again. And I think that's just discouraged the miner investors. And so they're more show me investors. It's like they're going to come in later. They're just not going to jump on the bandwagon so quickly.
Do you think cryptocurrency or Bitcoin has any interaction in this conversation with the performance of gold and silver? I know a lot of people have mixed feelings. I know there's like the metal diehards that, no interaction. I think there's some people that are thinking Bitcoin is going to overtake it at some point in terms of being a currency or just a preservation of value. Just really, really curious if you think that cryptocurrency Bitcoin fits into this in any way.
Yeah, I'm not saying we didn't lose some investors that used to be traditional metals investors to Bitcoin. I'm sure there are. People think it's, it's digital gold or whatever.
Right.
So I'm not saying that hasn't happened at the micro level. On a macro basis, what we're seeing in gold and silver's own problems, or particularly silver's own problems. It's not. I think Bitcoin has little to do with any of it, and not going to hold back gold and silver now or post bust. My target on gold is 20,000 by early next decade. My target on silver is 500. So clearly, I'm not thinking Bitcoin's an issue, and I don't know what Bitcoin is in that. Maybe it flies too, or maybe it doesn't go. It could be. I have no opinion on what Bitcoin's going to look like after the bust. Or frankly, it's got to prove itself in the bust before you can have any idea what it's going to look like.
What it does, yeah. Awesome. One last question before I let you run. When I think about a lot of the technology that's coming out, there's expansion of artificial intelligence, general robotics. We're now starting to talk about quantum computing, although that still seems like it's a bit of a ways down the path here. Do you think from a commodities metals perspective that there could be some sort of larger production of some of the materials that ultimately feed into those broader systems? So things like lithium, for example, kind of going to like the battery side of things. Just thinking that from a commodities perspective, if there's going to be this really big technological revolution, it needs to be supported by, an underlying hardware infrastructure of some sort. Do you see any specific commodities, anything like that, that is more friendly, more likely poised to benefit from that movement?
Yeah, for sure. I think silver is a good one. I mean, silver, obviously, in EV and solar panels and in lots of technology areas, it's increasing the need for silver and the demand for silver. So I think, yes, lithium, silver, some of those metals are going to see increased demand because of technology. And we're going to obviously see increased power needs because of technology. So, that benefits oil later on down the road. Um, so, yeah, I think for sure. On the other hand, what I would say, this isn't really a question, but post bust, if the environment is what I think it's going to be, which is unlike the last 42 years where interest rates ratcheted down from 15 or 20% down to almost zero, um, the next cycle post bust, they're going to ratchet up from zero to 20% and higher. Um, that is not an environment for growth stocks. So there will be growth stocks that can outpace that kind of move in interest rates and the effect it has on PE multiples, et cetera. There'll be things probably in the AI field and maybe quantum physics, et cetera. But generally, whereas growth was the name of the game for many, for the last several decades, the name of the game in the next cycle post bust is going to be resources. It's going to be commodities because there's going to be a real scarcity. Partly for what you just asked about, that feeds into that same thing where demand's going to far outstrip supply. And there's only one way for prices to go if demand outstrips supply by the amount it's going to, and that's straight up.
Got it. Okay. One last question. I promise I lied to you before. I was just thinking about this as we were talking. Nuclear energy. Do you think that starts to take a larger role in providing energy at this point? Do you think that there's a feeder opportunity there?
I think so. I mean, you definitely have improved the technology and they've rethought it. So it's no longer these greenfield plants that take 15 years in the planning. And so the supply comes online 20 years from now or 18 years from now. And that's not realistic. So now you have these smaller nuclear plants that can be built pretty quickly and don't don't have to cross so many regulatory hurdles. And I think that's the way to go. So for sure, we're going to have a shortage of energy. There's no question. That's just like commodities, energy is going to be a commodity that it demands far outstripping supply. We've constrained supply in all those areas, in energy and all our commodities, and then all of a sudden you have this huge, massive fiscal and monetary pump, stimulus, you know, 20 trillion from our Fed, something, 15 or 20 trillion from our government in terms of new fiscal, all of that. And the same thing going on around the world. You're just going to have this huge spike in demand for things. Here it's going to be the story's going to be we're reshoring, we're building new plant and equipment. We're bringing our capacity back on shore, and that demands a lot of commodities. Elsewhere, there's going to be stories around the world why there's a need for all these resources. But the story is that there's going to be this massive demand, and energy is definitely one of them. Electricity is definitely one of them. So I think, and I also think the next 4 years we're going to be much more commonsensical about how do we develop this energy. Is not going to be windmills. It's not going to be some solar. It's not that those things are going away, but I think Trump is going to be much more about we need to go where we can get the biggest bang for our buck and where it makes much more sense economically, and that's nuclear. As well as you're going to continue to see fossil fuels. They're not going away; they're going the other way. I think the next, between now and the end of the decade, fossil fuels are going to be expanding big time, not shrinking.
Makes a ton of sense.
If we had had a different president, that wouldn't be the story. But under Trump, that's where we're headed.
David, as always, it is absolutely awesome to connect with you, to pick your brain a little bit. I'm just grabbing your X page, which is Dave H. Contrarian. I will throw a link in the description below for everybody that wants to look you up there. You have your newsletter still, I presume. They can DM you to find out more about that.
Yep.
Is there anywhere else?
No, that's pretty much it. The letter is a quarterly letter. My first quarter letter just went out. And it is by subscription. So yeah, they can DM me for any information if they're interested. Let me just say, I've said it before, I think on your channel, and I saw it again this week. I very rarely do, other than these YouTubes, I very rarely do where I do my own post to let people know that there's a new interview out. But other than that, I rarely initiate posts. Most of my activity on X is replying to other people. Now, I may reply to other people 30 or 40 times in a day, and sometimes a dozen times, but mostly I'm on there doing a dozen or more replies, sometimes much more. And then I put out an individual, I initiate a post like I did, I think yesterday, saying I think there's a big reversal here in the stock market, bond market, the metals market, and the currency markets they're all coming together right now to begin big reversals in whichever direction they were, opposite to where they've been going. I put that out, and it never fails. I get a few posts from people, replies from people going, either where have you been, or it's nice to see you post again after such a long time. And I'll go, I'm on here every day, actively on here every day. So what that means is people, and I'm not a Twitter expert or an X expert, but I have learned at least this much. There are settings you have to go to and make sure you're set to get notifications of my replies. If you're just set up to get my initiated posts, you're not going to see hardly any activity.
Right.
So for a lot of people, you're missing thousands of posts, if not tens of thousands of posts from me, because your settings are not set up to see the replies. And that's where my replies are really where I educate, where I use a reply to an individual to basically make a point,
a broader point,
to a general audience, not always to that individual. So.
Yeah, thanks for letting them know. They can definitely go to your profile on there. They'll see that there's a little bell, and if they click the bell, they can be alerted to pretty much all your posts. So, and if you can't figure out how to do that, I mean, they just need to go to Google, because it's pretty easy. But thanks for
well, you
making them aware.
me, because I didn't even know that. So.
Yeah, it's all good. So, but as always, absolutely awesome connecting. I'll connect with you offline to set up another time to talk in a few months and see how things progress. I am eager to know what ends up happening from here.
Yeah, I think we're in for a few months of fun here, so enjoy it.
Awesome. Yeah.
Thanks, Eric.